Welcome to Business with Louis, the show where we break down complex business concepts into actionable insights. Today, we're diving into the debt ceiling, politics, a crucial topic that affects not just governments but also businesses and entrepreneurs. So, let's get started. The debt ceiling, politics refers to the self-imposed limit on the amount of debt the U.S. government can incur. But why should you care about this concept as a business owner or entrepreneur? Well, understanding the debt ceiling, politics is essential because it has real-world consequences for businesses and investors. When the government's creditworthiness is called into question, it can lead to higher borrowing costs, reduced consumer confidence, and decreased economic growth. To grasp the debt ceiling, politics, let's briefly touch on its historical background. The debt ceiling was first introduced in 1917 as a way to manage government debt during World War I. Since then, it has been raised or suspended numerous times to accommodate growing government spending. However, the debate surrounding the debt ceiling, politics has become increasingly politicized, with some arguing that it's essential for fiscal responsibility and others claiming it's an outdated concept. One key concept is the idea of fiscal policy, which refers to the government's use of taxation and spending to influence the overall level of economic activity. Influential thinkers like John Maynard Keynes have shaped our understanding of fiscal policy, emphasizing its role in stabilizing the economy during times of recession or inflation. Another important principle is the concept of creditworthiness, which refers to the government's ability to repay its debts. A country's credit rating, as determined by agencies like Moody's or Standard & Poor's, plays a significant role in determining the interest rates it pays on its debt. When a government's creditworthiness is called into question, investors may demand higher returns to compensate for the increased risk, leading to higher borrowing costs. Let's look at some real-world examples to illustrate the debt ceiling. Politics in action. In 2011, the U.S. government came close to defaulting on its debt due to a contentious debate over raising the debt ceiling. This led to a downgrade of the U.S. credit rating by Standard & Poor's, resulting in higher borrowing costs for both the government and businesses. Another example is the European sovereign debt crisis, which highlighted the importance of fiscal discipline and credible economic governance. Countries like Greece and Portugal face significant challenges in accessing capital markets due to concerns about their creditworthiness, leading to austerity measures and economic reforms. So, what can we learn from these examples? For one, it's essential to understand that the debt ceiling, politics is not just a political issue. It has real-world consequences for businesses and investors. When the government's creditworthiness is called into question, it can lead to higher borrowing costs, reduced consumer confidence, and decreased economic growth. If you're an entrepreneur or business owner understanding the debt ceiling, politics can help you make more informed decisions about your own finances. For instance, if you're considering taking on debt to finance your business, you might want to think twice during times of economic uncertainty. Alternatively, you could explore alternative funding options, such as equity financing or revenue-based loans. According to a report by the Small Business Administration, small businesses that have a solid understanding of their cash flow and financial management are more likely to succeed than those that don't. So, it's crucial to stay on top of your finances and be prepared for any changes in the economic landscape. In addition, business owners can take steps to mitigate the risks associated with debt ceiling uncertainty. For example, they can diversify their funding sources, build up cash reserves, and prioritize investments in areas that are less sensitive to interest rates and economic volatility. To further minimize risk, entrepreneurs can also consider hedging strategies, such as using derivatives or other financial instruments to manage exposure to interest rate fluctuation. Moreover, Staying informed about economic developments and policy changes can help business owners anticipate potential challenges and adjust their strategies accordingly. By grasping the underlying principles and theories, you can better navigate the world of business and finance. Remember, every great business starts with action, so don't be afraid to take the first step, whether it's exploring new funding options or simply staying informed about the latest economic development. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.